Hello, thanks for joining us, Tony.
Hey Steve, nice to be here.
So I thought we'd start off with a few topical questions that are sort of in the news lately. One of the things, Scotland is voting today on independence. Blackstone has a lot of European exposure. Wanted to see what your thoughts are on Scottish independence, or if that could have any effect on the euro or your exposure to that continent.
Well, first of all, I don't think it's going to affect Blackstone much. We don't have many companies in Scotland. And actually, I don't think Scottish independence is going to affect much of anyone much except Scotland.
Sure.
And I think it'll have a big effect on Scotland. That doesn't mean they won't vote for independence. There's hundreds of years of animosity between the English and the Scottish, and it's sometimes hard to get over the emotion of it. But I think at the end of the day, they probably won't vote. But I've been trying to get on I was talking to our people in London this morning, and as you all know, exit polls are illegal in England, so we're not getting a good read on what's happening. But wouldn't be surprised. I did vote for independence either, given the historical animosity, and frankly, given the unpopularity of Cameron and the Tory government there. Let's not forget that Scotland has about 235 seats in Parliament. Yeah. All but 5 of those are Labour seats. So I think they feel very much like the government in England isn't there to serve Scottish people. And there's sort of just like in this country, there's a backlash against party of power there going on as well. It'll be interesting to see, but I don't think it'll have a big economic event outside of Scotland.
You think we'll see Quebec vote for independence again if Scotland does it, or do you think it'll become a trend of some kind?
Yeah, whether it's Catalonia, Quebec, Belgium, I think you'll see some other independence movements, particularly if this works well. I'm not sure you'll see them right away, but if this works well and Scotland is able to transform its economy in a successful way, I think it'll put fuel on those fires.
So another big, probably one of the biggest financial news stories of the year is the Alibaba IPO. Blackstone doesn't own individual shares of companies, but I thought it might be a way for you to talk about Asia. Alibaba is sort of a bet on more growth in China. Are you as bullish as some of the other folks are out there on Chinese growth, or less bullish, or sort of in the middle?
I'm probably on the pessimistic end of Chinese growth in terms of intrinsic growth. So for a while, China was growing about double digits.
Sure.
It needed to, because it needed to absorb a lot of influx of workers into the labor force, mostly moving from rural to urban, but also a growing population, a young population. Starting next year, for the first time, China starts to have a shrinking working age population. Mm-hmm. And by 2050, it'll be, after Japan, the second oldest population of any major economy. So the imperative for growth that drove China to grow at 10 to 12%, because an unelected government survives with full employment. That's sort of what happens there. That imperative for growth is going away. So it has the luxury of growing more slowly. It drove the growth through an investment economy, over-investing, if you will, in fixed assets, not just infrastructure, but plants, plant equipment, manufacturing companies also. It now has to pivot not only towards the consumer, but towards social programs to take care of the aging population. So all that won't drive productivity, it won't drive growth. So I think China's economy wants to grow at about 5 or 6%. I think China has the resources and the government control to continue to have it grow 7 to 8%, which is where they're targeting right now. President Xi is new. I don't think he wants to take it down too quickly. And of course, the numbers are never totally transparent in China.
Sure.
But I think over time they'll trend to 5 to 6% growth. With the U.S. trending towards 3 to 3.5%, it's not that different. It's pretty interesting.
Yeah. Okay. So China's still going to grow. Let's bring the topic back to the U.S. at least indirectly. You were in Washington a couple of weeks ago, where you told Politico.com you had a plan to discourage tax inversions. Those are the deals where, there's one example recently where Burger King is buying Tim Hortons and moving their headquarters to Canada. You have a plan on tax inversion of discouraging tax inversions. There's actually talk in Washington you becoming Treasury Secretary, which is interesting too. But so what's your plan on tax inversions? But the bigger issue is that trillions in off-seas money, corporate money, that should be repatriated to the U.S. Sort of two somewhat related issues. What are your thoughts on both of those?
Okay, well, You threw a lot of stuff in there.
I know.
So,
I do that.
So let me just start by saying I think tax inversions feels bad.
Feels un-American.
As I said, it feels un-American, but actually it's not a very big economic event. The estimates show that it would reduce federal government income tax receipts by about 1/10 of 1%. So to put that in context. And when a company does that, it doesn't move assets, headquarters, people, which is a good thing because we want corporate headquarters, operating headquarters in America. It just sort of reincorporates. And it continues to pay full income taxes on its U.S. income. What it doesn't do is it doesn't allow the government to tax foreign source income. But the reason there's $2 trillion of cash sitting in corporate balance sheets, much of it abroad, is because we're not taxing it. They're not bringing that cash back, which triggers the tax. And so, so I don't think it's a big economic event, despite all the
tax inversions. Yeah,
tax inversions. And I don't think you're going to solve that with comprehensive tax reform, because I don't think corporate or individual plus corporate, because you're not going to get that done in Washington. So I think the only way you stop it, which I think there's the public opinion to do and the political will in Washington to do, is through Treasury regulations. Put that aside, we can go through what those might be, but that's not quite that important here. I think that what people lose sight of is that $2 trillion sitting abroad is much more destructive of economic growth in the United States than I think people in Washington perceive. But they view that as an opportunity cost of not bringing it back and taxing it. I don't think that's, there's some of that, but I don't think that's the big cost to America. I think the big cost to America is that money sits there in bank accounts earning almost nothing. So when a company wants to build a new plant, even if the United States is a competitive place to build it, and usually if the United States is competitive economically, a company will want to build that plant at home. It's easier to manage, the cultural differences, everything. For a lot of reasons, they want to build it at home. However, with free cash sitting over there that you don't otherwise have a use for, where are you going to build it? You're going to use that cash rather than cash here that has a much higher cost. So it's driving corporate investment abroad. So I think Washington needs to solve this problem, not to collect taxes, but to stop that artificial subsidy, if you will, with very low cost of capital of American companies building plants and equipment abroad. So that's where I think the destructive part of this whole issue is. And you know, when you talk to people in Washington, they say, I don't want to have another tax holiday to bring the money back, even though it would give a short-term boost, because it would encourage people not bringing back, waiting for that again, and we'll never get the full taxes on those foreign earnings. I don't think we're ever going to get them anyway, given the differential tax rates between the United States and the rest of the world. So I think we should worry about the incentives to invest abroad that the cash is having, and try to get some taxes and get that money back to the United States.
It would be great if we could get it back to the United States. There's no question it would help our economy. You know, we've got, you mentioned Washington, we've got midterm elections coming up. The Democrats face a fight to keep the Senate. Wall Street, however, seems to like gridlock. Do you think if we do have a continued gridlock in Congress, it's going to help the stock market, or what effect is that going to have?
Well, I think gridlock is fully priced in the stock market. I don't know that Wall Street likes gridlock so much as it doesn't like uncertainty, and I guess we've had pretty stable conditions for a while. But I believe that if we got Washington functioning, and we got some legislation that most of business would applaud, immigration reform, infrastructure spending, I think a higher minimum wage, a bunch of other things. If the parties were coming together and we had senators from both parties legislating, as I said down in Washington, I think the president would respond in kind. I think he's pragmatic, decisive, and wants to see things done. I think actually the stock market would respond very favorably. With Wall Street, would respond very favorably. Actually, we get another leg up, and I think we get higher economic growth, which would further fuel that. So I think gridlock is the status quo that's priced in there. The market will negatively react to that. But if the Republicans in Congress came to deal in government, the president responded in time, and he got some stuff done, I think we'd have a very strong positive reaction.
Okay, great. So let's turn to another aspect of Blackstone. You have publicly traded units. You're in the public sphere, yet you're a private equity firm. On the public side of things, I just want to ask you about the impact of social media on portfolio companies. We had a story, a cover story, Louisa Beltran, my colleague, and David told a story about a CEO at a portfolio company that got fired for a video that went viral of him abusing a dog, kicking a dog. It was Olympus Partners portfolio company. And Blackstone as well has had to deal with the documentary Blackfish impacting SeaWorld. How do you deal with this as a private equity chieftain, as a CEO? It's a reality. We've seen also in the NFL recently, some viral videos there that have been very, incendiary. So how do you deal with that kind of stuff nowadays?
Well, I took up golf recently, and when I come back and I have a 130 stroke around, I don't beat the dog anymore. The whole world changed 7 or 8 years ago, partly when we all went public.
Yeah, you were the first to go public.
And all of a sudden, so it's not that different. We've been living in a fishbowl, it feels like, where the spotlight's on us all the time, and all kinds of people are watching very carefully what we do. From social media, like you say, all the way over to regulators, to politicians, to the press. It used to be private equity. It was a pretty private business. A lot of small players. We kind of stayed under the radar screen, and we didn't get a lot of attention. But that changed in the last 10 years. So we're very mindful of the fact that we are, right or wrong, whether we like it or not, public figures. We get watched. What we do gets reported on. Private birthday parties become cause celebs.
Sure.
And that comes with the territory. So I think we try to be careful. We make mistakes, but we also try to use it as a tool. One of the most popular things we did is when we got the penguin from SeaWorld, and they ran around our offices for a while. That kind of went viral too. And
Real penguins?
Real penguins.
I didn't see that one.
Yeah. And so they're running down the hall, and there's a little person from SeaWorld with a rag, cleaning up now and again as the penguin runs down the hallway. But that whole thing softened Blackstone's image and made it look friendly and made it look, which it is, by the way. That's I don't care about that. But so it can be a very useful tool for getting stuff out as well.
Some private equity guys blog, and some of them don't. I know Blackstone has a Twitter feed that's been around for a while. So I'm sorry, I was just going to point that out. So it's something you're aware of.
Well, too many of us at Blackstone are too old to know how to blog.
Yeah.
But I think what I was going to say is that I think the social media really connects to the next generation.
Sure.
It's not people like even you, Steve, probably.
I'm not that young.
but it's an excellent tool for connecting to people you're trying to recruit.
Sure.
So that's its main use for us.
Okay. We've had some reports that Blackstone has begun marketing at $16 billion for Blackstone Capital Partners 7. It's expected to close maybe as early as next year or as early next year. I know you can't comment strictly on fundraising, but I was hoping you'd address Blackstone's past performance. Blackstone Capital Partners 6 posted a 17.5% internal rate of return and a 1.2x multiple as of March 31st. According to performance data from CalPERS. But you have Blackstone Capital Partners 5, which I think SeaWorld is in as well. That has a 6.9% IRR. Are you happy with the performance of Blackstone 5? Obviously, Blackstone has had many other home runs, like its real estate funds, TAC Ops. But what's the story with Fund 5?
Well, in general, I think we are very proud of our record. It's been about 17% net of all fees compounded for 25 years.
That means you double your money every like 6 years or so.
Yeah, well, every 4.5 years.
4.5 years, yeah.
We've never had a fund, we've never had a general private equity fund that lost money. We've never had a private equity fund that didn't turn at least 2-to-1 to investors. I think Blackstone 5 is up to 1.6 or 1.8, I don't remember now. It'll be a 2-to-1 fund before we're done.
Yep.
And considering it was a peak fund, I think that's pretty good. I listened to Josh's comments about large investments. The largest investment in that fund is Hilton, and it's of course one of the biggest gains in history. It's going to be three times money for us. So I think we've got some great investments in that fund that are still not mature, and those companies are growing very well. They're paying down debt, and they've got great management teams, and so that's accreting value very quickly. We have 2 open funds now in private equity, 6, which is running at a 29% IRR, and then we have our energy fund, which is running at, I think, a high 30s, maybe low 40% IRR. They're 2 of the best funds in terms of IRR we've ever done, and they're both big funds. So I don't see any indication at all that our ability to drive returns is reduced in any way, shape, or form. And we focus on doing a few things well. Operational intervention is really important. I listened to Josh talk about that, and the statistics aren't compelling. I think he said about 25% of the value came from that. I'm not surprised at that, because you pull hundreds and hundreds of private equity funds. I'm surprised it's that high, because of the hundreds of them, I don't think there are 5% of it that do it well. And so I'm surprised it's that high. But for someone that does it well, I think it is 80 or 90% of the return. And I think we do it well, and that's what it is for us.
And the TAC Ops has been doing, it's early days for that, but that's supposed to be doing pretty well.
It's been a spectacular fund as well. That's an IRR in the 20s. Also, in current yield, double digits, and it's been a great fund, and it does different things. So we see a lot of opportunity to put money to work still, believe it or not. And I think one thing about private equity, you really can't market time with it. If you find good top quartile investors and stick with them over the cycle, you'll do very well, way better than public markets. But you can't go in and out.
Sometimes private equity returns can be a little lumpy anyway. As the funds mature, they kind of jump around a little bit. So one comment that jumped out at me from your Politico interview is that Blackstone's quickest growing segment is its legal and compliance department. The Securities and Exchange Commission sort of dropped a bomb earlier this year on fees, namely that private equity firms don't disclose all of what they're charging LPs. Any reaction to the SEC? Do you think that the Blackstone is clear enough on this issue with its investors, or could it improve somewhat on fees?
Well, I think the SEC comments were politically motivated, and if you read them carefully, it said most players did a good job.
Yeah. We don't dwell on that as much as the media, I guess.
No reason you wouldn't. We've been really clear about the disclosure to our LPs, and I think flawless about it. And we disclose every fee from every portfolio company to us, to any part of us. And the SEC audits us to death every couple of years, and we've had problems with it. So there are lots of ways that private equity firms can get paid and need to get paid. I think the market's shifting away from fees, but what will happen is eventually you'll see that in higher management fees. I'm not sure that's better for investors, but by hook or by crook, private equity firms are economic animals, and they need to pay their people. They can't just live on carry because it's too lumpy. And you go through long periods of time where your people don't earn any money. So, but I think there are also different firms that have different models. Some firms charge their portfolio companies for the portfolio intervention. We don't, but other firms do. But I think if LPs go in, they understand what they're getting. That's the important thing. And all that is flushed through net returns at the end of the day. So if we can continue to return to our investors 1,000 basis points higher annual return in the stock market, they'll be happy.
Okay, great. Blackstone Alternative Asset Management, BAM, is, I guess, the largest hedge fund manager in the world, or right up there. We had another headline this week was from CalPERS cutting back its exposure to hedge funds. They're an LP that a lot of other LPs do watch. Is that anything that's on your, that's a concern to you, or what's your reaction to what CalPERS is doing?
I think they made a wise decision, frankly. The returns from their hedge fund program were poor. We actually have a long history with CalPERS. The first hedge funds investment they made through our BAM area, and then they decided to go direct. And they had sort of an interesting process where they broke the decision process into pieces, and they ended up with returns that were sub the stock market by a lot, and just not good enough to justify the program. My recollection is their returns are about 400 basis points lower than our returns. Mm-hmm. And so why go through all the brain damage and have all the staff and all the administrative costs of picking hedge funds when only to underperform someone like us, such as in the multi-manager business, where they could just give us money and get diversification they want by 400 basis points. It makes no sense. So I think they made a wise decision, actually. Also, so it'll be interesting to see what they do. But a lot of people think hedge funds are supposed to be higher return vehicles. And I think most institutional investors now do them as a way to play the stock market with lower volatility and somewhat lower returns. So to compare hedge funds returns, to a 5-year period when the stock market's done nothing but go up isn't really right either. I think the important thing to remember is it's much lower volatility. So our volatility is about a quarter of that of the stock market, which means that we capture about 60% of the ups in good years. So in years, in 5 bull markets will lag, but we have much lower percentage in downs. In fact, in the 10 worst market months in the last 5 years, where the S&P was down high single digits, we were flat, 0, so no loss. And so over the cycle, actually, if you don't lose money in the down markets and get 60% of the ups, you outperform the stock market with also lower volatility.
Right.
So that gives you higher returns and lower risk. But you don't expect your hedge fund portfolio to shoot the lights out in returns. You save that goal, if you will, for private equity, for real estate. Those are about the only 2 alternative areas where you put big money to work and earn premium returns.
So that story probably plays pretty well with LPs in the sense that they're still going to go with hedge funds as a way to kind of smooth out some of the volatility. You don't see that changing because of what CalPERS
No, I don't.
doing.
I don't.
Okay, great. Yeah, in terms of, we had some other news this year with the settlement of the club deal. The club deal collusion lawsuit. Carlyle was the last firm to settle with it. I think they paid about $100 million on that, or a little more than that. What's your view on club deals? Are we ever going to see club deals again? Sometimes we've been seeing some deals with maybe 1 or 2 private equity firms, or maybe 1 private equity firm and a big LP. Is that the shape of the thing of the future, or are you guys thinking about doing any big club deals anymore?
Yeah, probably. First of all, club deals are perfectly okay and are actually necessary when the deals get really big. But none of us really want to do a deal with our competitors. I mean, these are people we compete with viciously at times, and it's a little bit of
you're not frenemies.
It's a little bit of an unnatural act to suddenly become buddies when you're trying to cut each other's throat simultaneously on another deal. And so, that's never been a natural act. Club deals hit a peak back there in 06 and 07 when there were lots of big deals. And at that point, while some LPs were doing co-invest, it wasn't near as pervasive as it is today. Today, there are lots and lots of LPs that are setting up co-investment programs. They're much more comfortable with it. They're much more comfortable with the lack of diversity or the concentration of risk associated with co-investment. So there's way more capital available for co-investment today than there was back in the peak. That means that, and there's much more pressure on people like us from the LPs for co-investment. They do that as a way of managing down their fees. So we have simultaneously, we prefer to team with our LPs because it makes us partners and it makes them more aligned with us. At the same time, they pressure us to do so. So if at all possible, we have a deal we're doing, we'll take that excess. Instead of calling a competitor and say, let's team up on this, we'll call LPs. And so so club deals are going to be many fewer, but if they're really, really big deals, you'll still see.
Okay, a couple of them. But you're not working on any 20, 30, or $40 billion deals right now, probably.
No, we are.
Oh.
It doesn't mean they'll happen.
Okay. Okay, that's an interesting comment. So yeah, in terms of, do we want anybody have a question for Tony? We're open up for questions. No, not right now. Okay. Yeah, another. Well, in terms of what you were talking about with the stock market, the deal prices are really high right now. What's your take on the U.S. economy? The U.S. It's been the expectation of growth that's been driving the stock market to these record highs. How much longer do you think this is going to last in terms of stock prices, and how are you going to get deals done if public equity prices are so high?
Well, first of all, I'm not sure it's been expectation of growth that are driving high stock price. I think it's low interest rates.
Okay, search for yield.
And where do people put their money? I mean, people don't really want to invest in bonds because interest rates probably are only one way to go, and they can sit on cash and it's not earning them anything. And where do they go with it? And if you feel like the euro's weakening and the yen's weakening, and you worry about currencies, the dollar looks like a pretty good place to go. So that pushes a lot of money. I think the lack of alternatives pushes a lot of money to U.S. equities. And we could talk about fundraising too, but because it has other ripple effects for alternatives. But so I think it's lack of alternatives is pushing money in the stock market. Actual corporate earnings growth is not high. Economy's doing okay, but corporate earnings growth is lagging the growth of the economy. And EPS is growing mostly because companies are buying back their stock. So it's kind of manufactured EPS growth.
Sure.
But look, this is a great time to be harvesting gains, and so that's primarily what we're doing. We don't, our job isn't so much to buy public companies. We might now and again, but most of what we do doesn't involve public companies. A lot of it's buying private companies, giving it growth capital, backing management teams to consolidate industries, finding broken companies we can fix up. A lot of times they're carve-outs. Sometimes they're public companies, but public companies in America are much better managed pervasively than they were a decade or two ago. So there's not a lot of low-hanging fruit there. And the activist investors and management's really kind of responsive to the kind of thing that private equity can do. So we focus really maniacally on driving unlevered returns above what the stock market can earn. And then when we provide leverage on all, it just magnifies that, but it doesn't create the return itself. The return itself is created through the unlevered returns. A lot of it driven by, virtually all of it driven by operational intervention.
And maybe more overseas deals too, right? Because there's probably better deals.
A lot of overseas deals, and a lot of we do a lot in energy. It's been about 40% of what we've done. And there we're actually creating assets. We're either building facilities that generate power, or we're finding oil and gas, and so on and so forth. So those companies, because we're building them, we're finding them, we're getting in at book value. And if we do that around talented management teams, it can drive some very nice returns. And it's independent of stock price levels and PEs and multiples of EBITDA and that sort of stuff.
So we're just about wrapping up. Let's get a bit of a view on a big picture view of Blackstone. $280 billion in assets under management. You've diversified very much so beyond private equity into a lot of other financial services arenas. You're more of an asset manager in some ways than you are a private equity firm. What's the future look like for Blackstone? Are there any new business lines you're looking at? There's been a lot of talk and interest around real assets and infrastructure. Anything that you guys might be thinking about in terms of growing the firm further in different areas?
Well, we are diversified. We're pretty balanced. Our four investing businesses are all about the same size. They all have, say, $65 billion of AUM thereabouts, 60 to 70. But I think it's important to realize that we haven't entered a new business since, certainly since the 90s. So all the business we've been in a while. I think a lot of other firms are scrambling to enter those businesses. But I think what distinguishes Blackstone is the other firms tend to be really good at sort of one business and are trying to build the other businesses and frankly struggling to have their performance and the quality of their position in those businesses equal their core business. Blackstone has four core businesses. Each of them is a global leader, or one of the two global leaders in its sector, in both size and in performance. And so that's what makes Blackstone unique amongst all the other firms. No other firms are leading in their performance across multiple businesses. We don't try to do a lot of things. I don't want a lot of small businesses. It's too hard to manage. I saw Josh reference the Sub-Saharan African Fund. It'd be a long time before we start doing that kind of thing. It doesn't scale. You get fragmented teams. It's hard to have a culture. It's hard to manage. I'm not that good a manager there. So we want to do a few things really, really well and do them at scale. And we want to be in businesses where scale provides sustainable economic advantages that are reflected in superior performance.
Sure.
Because that way, you try to have the best teams you can, but as your teams evolve and turn over, we don't keep everyone we want to keep. Your performance never budges. It's always up there in the top quartile, as it has been for us. So when we think about adding businesses, they've got to be businesses that can be big. They've got to be businesses that benefit from the intellectual capital and the information flow, the context that we have. They've got to be businesses that make our other businesses better by bringing their own contribution to that pot. They got to be businesses with relatively few bodies. I don't want hundreds of bodies out there. I don't want to be in the long-only equities business or anything like that. They've got to have the potential in terms of the quality of the leaders and to have sustainable world-leading performance. So when you add those up, there aren't that many things that really qualify. We're not in infrastructure. You know, maybe we could be. We don't have the presence in emerging markets that we might have someday. That would be, and we do have a great position in Brazil, which is through Patria, which is going to expand throughout South America.
Yep.
And I think we'll be the leading investor down there across all the different asset classes. But there are plenty of other emerging markets out there. We've talked publicly about commodities and real assets some, and that's of interest. I haven't decided exactly how to play that yet.
It could be a hedge, an inflationary hedge, I guess.
Could be, yeah. So there are some other things that are out there that are targets of opportunity. We'll see.
Okay. Well, Tony James, speaking of targets of opportunity, it was a great opportunity for all of us to hear you. And thanks a lot for joining us.
All right, thanks.
Thank you very much.